What's up, my friends? Welcome to the part 2 of what makes real estate a good investment. In the first part, we broke down the two main things that makes real estate a good investment. You can check it out right here. Now in this video, we're going to do a deep dive on specifically the qualities of real estate that sets it apart and gives it advantage over the other asset classes. But we challenge our bias in this channel. We're not going to paint rainbows and butterflies over real estate. We're also going over all the disadvantages that real estate can have compared to other asset class. Watch the whole thing and you might pick up a thing or two in your investment journey. Disclosure, I am a real estate professional. However, I'm not a financial advisor, and I actually encourage everyone to take responsibility and take charge of their own finances and be their own financial advisor. I don't want to waste your time. Let's get to the video. How do you make money with stock? For the most part, you buy low, you sell high, you pocket the difference. How do you make money with Bitcoin? Same thing. Buy low, sell high. How do you make money with gold? Same thing. You pocket the difference. There's only one income source during the whole transaction, from the time you enter the investment to the time you exit it. The only income source is the difference between how much you bought it for and how much you sold it for. There's obviously other strategies to gamble with stocks, to invest with stocks, but in general, your income source has one dimension. How do you make money with a bond? You buy the bond with a guaranteed return, a treasury bond, for example. A treasury or government bond, let's say you buy $1,000 1-year treasury bond with a guaranteed 5% yield. You're basically buying the bond for $950, then in 1 year time you'll get a full $1,000. That means you made $50 your 5% yield. In this example, you still only had one source of income from the time you bought the investment to the time you exited the investment. All these asset classes are one-dimensional income source assets. Enter real estate, where you get a multi-dimensional income source from the time you enter the investment to the time you exit it. Do you even really have to exit this investment? These 5 income sources of real estate are appreciation, cash flow, loan paydown, return on amortization, tax deductions. Yes, you get 5 and not 1 income source. This depends on how you plan to enter and exit your real estate investment. For example, you buy the real estate for $100,000, wait over time, let's say 1 year has passed, then you sell the home for $110,000. The value of the home increased 10%. Now you have a 10% ROI. This strategy is called flipping. You can make the deal sweeter by forcing appreciation, by doing repairs to increase value for the home. But all in all, you're only getting one source of income in this strategy. And let's not even talk about the expenses you're going to have while holding this property for it to appreciate. This flipping strategy to me is like treating real estate like a stock. What if you bought it and the market suddenly tanked? Because nobody ever really knows for sure. And now you can't sell it for more than you bought it for. For me, in my opinion, the right way to invest in residential real estate is to buy and hold for long term, where you can capitalize on all the 5 income sources that real estate can offer. For example, a single family home, if you put a tenant in the house and then the property cash flows, meaning the house is renting more than all the monthly expenses you have in it, the money left at the end of the month is called cash flow. Since your property is cash flowing positively, that means you're getting the other benefits as well, such as loan pay down, meaning your tenant is actually paying off your loan for you. Then you get the return on amortization, where as long as we keep having inflation, the value of your loan is worth less and less and less every single year because inflation erodes debt. Why do you think that we're always in an inflationary environment in the United States? Most of the time. And the government has trillions of debt. Are they trying to erode the unpayable debt they made? But that's a topic for another video. Back to real estate. So if you buy and hold your properties, you're taking advantage of all 5 income sources in one powerful real estate investing strategy. You, the real estate investor, you try your best to time the market and negotiate to make sure you're buying it low. Maybe do some repairs to create some forced appreciation from the start. Plug in a tenant in there. Now the tenant pays your loan off. You get cash flow every single month. Inflation erodes your loan. Then with all your expenses while holding the property the tenant is paying for anyway, they give you a business loss or tax deduction at the end of the year. This is not a tax advice and I'm not a CPA. Now, it's kind of hard to calculate your true ROI because sources of income are coming on all sorts of angles, all sorts of directions. Another reason that sets real estate apart from other asset class is you don't actually have to sell off the asset in order for you to realize your gains. Let's say you buy stock here, this timeline, and then you sell it off right here. You made 5% on your initial investment, but this gain is only on paper. It's called unrealized gain. You can't use it unless you sell off the stock. And when you sell off the stock, you're missing all future appreciations. With real estate, you can keep the real estate, do a cash out refinance, take a chunk of your equity to reinvest to another real estate asset while keeping your original investment so it can keep accumulating appreciation, cash flow, loan pay down, return on amortization, and tax deductions for you all over again year after year. Another reason that sets real estate apart from other asset class is leverage. Will a bank let you buy $100,000 worth of gold and only pay 3% down payment and pay off the gold over 30 years? No. Will a bank let you do that with a stock or maybe a Bitcoin? I don't think so. Real estate allows you to enter bigger investments with smaller initial capital because of leverage. Because even if you made a down payment of 3%, when the market value of your real estate appreciates, it won't be on that 3% or $3,000. It will be on that $100,000 or 100% of the value of your real estate. You're getting the appreciation of the whole thing, even if your down payment is only $3,000 or 3%. If you buy a $3,000 worth of stock, gold, or Bitcoin, a 10% yield on that will only be on $3,000 because there is no leverage. Another reason that sets real estate apart from other asset classes is you get to decide what to do with real estate. Whether it will perform or not, you get to manage it. You get to add more units, you get to Airbnb it or rent it or do a farmhouse. You could alter the property so you have choices and you get to decide what to actually do with it. And it's actually forgiving just in case you made a mistake that like right now, a lot of Airbnbs are not working out. And if you bought your real estate right, it should still also be cash flowing as a regular rental. So you can easily change it from Airbnb to a rental property and it will still cash flow and make the asset perform. Regarding stocks, you're really most of the time you're really an outsider and you really can't decide on what's going to happen to the stock. All you can do is do some chart reading, read some news, read some balance sheets and PE ratios. With Bitcoin, the value mostly depends on the hype and the panic because they don't really know what to do with that asset class yet. Right now, you're probably, wow, real estate is awesome AF. But like I said, there's a downside because everything's a trade-off. Please type in the comment section on what you liked or didn't like or what future videos you want to see and that will really help me out in making future videos. Let's get back into it. The downside of real estate investing. Gold, silver, Bitcoin, even treasury bonds. You can just hold it and not have to spend money while holding it. With real estate, if you are or you're not cash flowing at all, you still have expenses to pay. Mortgage, repairs, HOAs, utilities. This is the only asset class that you constantly need to throw money out every single month just to keep it. And occasionally, a big expense like roof, water heater, HVAC, etc., etc., etc. They say real estate appreciates, correct? Try not doing these repairs and let's see how well your real estate appreciates. Yes, your real estate appreciates over time against a dollar, but you also have to throw money every single month to keep this asset and to get that appreciation at the end of the rainbow. So, if your property is not even cash flowing, forget it. This is why a primary resident that you own and live in and you're not renting it to other people that's paying you, it's not an asset. It's not an investment. I don't care if your realtor or guru says it is. It does not put money in your pocket. It may or may not appreciate in the future, but you don't really know that. Investors look like geniuses during good times. When stocks are booming, real estates are booming. Everybody looks good. It's all over social media. But Warren Buffett said, you don't know who's swimming naked until the tide goes out. That means during hard times or recession is the only time you'll see which investors are doing it right fundamentally. who knows how to earn money on the upside and also know how to protect themselves during downside. Do you even hear a lot of good house flipping story nowadays? There are maybe still some since real estate is hyper-local, but it seems to me most of that hype is gone right now. There's that quote that many real estate investors have said, cash flow is king. No tenant, no cash flow. That means your real estate is not an asset if it's not for your tenant. Leverage, which was one of the reasons I told you that sets real estate apart from other asset class on the good side, it's also here on the downside. Sure, back in 2008, when a lot of people got foreclosed during GFC, the Great Financial Crisis, sure, some of the homeowners that lost their homes, some of them have their houses free and clear, and they were foreclosed because they couldn't pay property taxes or insurance. But majority of people who got foreclosed are people on a mortgage. It'll be a lot easier to sell off a home with 100% equity, and a lot harder to sell a home with a mortgage. And in some cases, the equity would be negative when the property is underwater. That means the loan is bigger than the value of the real estate. Another downside of real estate, they tell you mortgage is always fixed. When you buy real estate, it's always better than rent because your mortgage never goes up. Wrong. Your property taxes, homeowner's insurance, which are part of your mortgage, both go up. It's actually a big problem right now for many homeowners. Even some people with those historically low interest rates are having a hard time because of the recent enormous increase in homeowners insurances and property tax. Other expenses that go up over time are HOA, flood insurance if applicable, house repairs, contractors, replacement parts, etc. So yeah, I hope tenants understand that's why landlords do need to raise rent. It's a business after all. And if business costs are going up, and therefore the gross income needs to go up too to stay in business. And if you're a landlord as well, if you're raising rents faster than tenants can handle, they'll either choose a cheaper property with a better price if there's one available. That's why I think that landlord and tenant relationship is really important. I hope you all learned something today. Please write comments down below. I need to know what you think about this video. I need to know what future videos you'd like me to see. And please like and subscribe. Have a good investing day.